Okay, so welcome everybody to Enhancing the Accountant Bookkeeper Connection series. That's myself for anybody who doesn't know me. Tanya Hiltz, I am a CPB and the founder of Cloud Bookkeeping Services and Tanya's Bookkeepers Bootcamp. Just a little bit about me professionally. So I was recognized as one of the top 21 influencers in the Canadian bookkeeping world, just in Calgary in May. I was voted as by my peers as for being an on the Insightful Accountant Top 100 ProAdvisor list. I was a HubDoc Top 40 cloud accounting firm for 2017, and Intuit oh my gosh, I can't speak today. Sorry, guys. Intuit Firm of the Future runner-up for 2017, a Black Swan alumni, Futurepreneur Canada volunteer mentor, a current member of the Intuit Trainer Writer Network, member of the Intuit All-Star team on the QB community group. So one of those that will answer. I know Jonathan here is one as well that'll be answering questions. We are a Platinum ProAdvisor firm, Advanced Certified QBO ProAdvisor, Certified QB Desktop ProAdvisor, certified in many apps like HubDocs, T-Sheets Pro, a certified professional bookkeeper with over 20 years bookkeeping and income tax experience. A little bit about me personally. There's some things that I love. So I love family experiences, and for any of those who don't recognize some of those folks, they are some actors and musicians, so we do like going out and meeting some of our favorite people. And of course, I like to experience that with my daughter. We do a lot of that together. And I'm also learning ASL. I think it's a very beautiful language. And of course, there's my family, my husband, myself, my daughter, and Rosie, who is also our office manager. There's Rosie taking a break, though. So with KATA Accounting, just a little bit about them from my perspective. So I've been collaborating with Jonathan and Bob for a number of years. We have multiple mutual clients together. They work in QBO, which is great because I think any bookkeeper who is on here knows how frustrating it can be in a QBO world to still be sending, PDFs and exporting, documents into Excel for accountants who aren't in QBO. So it makes it a lot easier, way better for collaboration and better for the client, when you're working with an accountant who works within QBO. They pay great attention to detail and offer outstanding customer service. Can't say enough about them. So take it away, boys. I will pass to you. And you don't forget to share to take away the screen sharing, and you can start sharing.
I'm doing that right now.
Beautiful.
All right, so everyone should be able to see the title screen, correct?
It's just starting to load. Yep. Okay, great. We can see it now.
Not sure how to. Oh, there we are. Okay, so, well, thank you for that lovely introduction. One thing I'd just like to build on is Tanya's and us, we're working on how to make work papers really work between the accountant and bookkeeper. We're starting to get some pretty exciting results. I know we have our first big test cases coming up very shortly. So that's something that we're really hopeful that will help a lot of people in the future, because right now we're doing a lot of the stuff that is similar, but we're doing it in Google Sheets and through Google Drive. And I mean, it's good, but it's not ideal, right? Anyway, a quick little bit about me. I have been considered a thought leader in accounting and technology. The firm was essentially born in the cloud. We're always looking to advance our understanding and knowledge about technology and to see where the beginning of that next wave of change is coming from, so that we can help advise our clients about what's happening, as well as, all the things that we all know about already. And as such, I was actually tapped to be part of the inaugural Accountants Council for Intuit. That was essentially a group of accountants and bookkeepers who were hired by Intuit essentially as a steering committee to help them understand our needs, understand our pain. And I was brought in there as the new firm, right? I was brand new. I did not belong there at all, but because of the forward thought, that's why I was tapped for that. We are a Platinum ProAdvisor and Intuit All-Star. You might see our comments on the in the community there. We are known collaborators. We really want to see improvement across the industry. All the bookkeepers we work with, we are trying to, in some cases, they're teaching us, but in other cases, we're really kind of giving more insight into what the accountants expect at the end of the year. I know our bookkeepers checklist is a big part of that, and it makes a lot. I mean, a lot of it is like does not apply, does not apply, does not apply, but some of it can really make you think and go, oh, I didn't consider that. I better go back and have a look at that. And that's the whole point of that, is to stimulate the thought. I have extensive experience in the mortgage industry. That's how Bob and I met. I have a couple rental properties and a lot of experience with rental properties. Most of our customers right now are e-commerce, digital, and affiliate marketing. And then we got a smattering of others, a few in the entertainment industry, things like that. For anybody who's in Toronto, please come visit the Japanese Canadian Cultural Center. I'm part of the board there and was brought in to help them switch from Simply to QB. And right now we have our film festival, which wraps up on Thursday. Lots of fun and some really cool things coming to the art gallery. And I think we're getting an exhibit called The Last of the Samurai, which should be pretty cool. Anyway, I'm also an avid fisherman and poker player, but I never get to play poker. Bob, why don't you tell us about you?
Sure. Actually, Jonathan, I've never played poker with you, so I don't know how good you might be.
Let's put it this way. I'm better than average.
Okay, I probably have something to learn then. Just a few words about myself. When I think back over my rather extensive career, it has four phases to it. The first one was kind of an academic phase where I did undergraduate and graduate work in mathematics at the University of Waterloo. Then I moved to a CA firm, as they were known in those days, and rose to the level of manager, working on some pretty large audits and coordinating with other offices in at that point it was a Big 8 firm. It's now morphed into KPMG at this time. Then I moved into the corporate world, working in pretty large corporations like Shell Canada. And I wasn't actually in the accounting area. I was in the financial planning area, kind of forward-looking financial statements and producing capital projections and that type of thing. And then I decided to go out on my own and do independent consulting. So I was fortunate to work on some pretty well-known companies and organizations. You can see them listed here. I was recently happily surprised when I was appointed a lifetime CPA, and currently living in Georgetown. This is kind of an umbrella over my entire career with my beautiful wife and our 4 cats. I love woodworking and watching the investment markets. So I think with that, we can move ahead with the presentation, Jonathan.
I just wanted to say, Bob really doesn't play up the Lifetime CPA award. That's the second highest award anybody can receive from CPA, the highest being an FCPA, or Fellow of Certified Professional Accountants.
Wow, congratulations, Bob. That's awesome.
Thank you.
All right, so I'm going to just go through this fast just to make up some time. The whole concept is that at the end of the year, there is cleanup to be done. There's almost a period 13 where you need to go over the books in more detail, check your work for the year, check your work for the month, make sure certain things are booked or at least documented well, to ensure that third parties, or the people who rely on our statements, have reliable figures to use. Not having reliable figures can create liability for accountants, and I'm not sure how it works for bookkeepers, but I imagine there's a potential there as well. So, what is shareholders' equity? Bob, do you want to go on with this slide?
Sure. Just want to give a brief overview of what we're going to cover in this session. We'll look at what is shareholders equity, and then look at the components, and you may be surprised at how many different components shareholders equity can be split into. We normally think of 2, maybe 3, but there can be up to a dozen different types of categories for shareholders equity. They can get pretty complex in the real world, so if you are dealing with your clients and you get into one of these complex areas, don't hesitate to reach out for some assistance. Then we're going to look at the act of incorporating, why incorporate and when to incorporate, what is the right time for an organization to take that step. And then we're going to look at the typical shareholder equity transactions that you will likely run across in your bookkeeping practice.
All right. So may I?
Yes.
Shareholders' equity is essentially what's left over. What's the net worth of the company? It represents the residual value. If you were to have to sell all your assets, pay all your liabilities today, what in theory should be left? So yeah, there is an order to shares, and there can be different, I guess, stages of payout, depending on par values of shares, shareholder agreements, share class types. But the two things that are common is when a company is dissolved, the debt is paid off first, and then the preferred shareholders. The common shareholders, it could be in a variety of different reasons. This is particularly important because it clearly identifies that the risk, the majority of the business risk, is with the common shareholders. Bob, did you have anything to add on that?
Yes. Just slightly saying I've been in situations where you're negotiating with different parties and different groups of people, and sometimes through the courts. I've sat in very interesting court cases where different debt holders, they have different priorities within the group of debt holders. So they're all fighting to make sure they get their piece of the action. This usually happens when there isn't enough assets to cover all the liabilities and shareholders' rights. So it can get very interesting in a wind-up of a corporation.
We don't do any bankruptcy and trustee. We are not licensed trustees, but in our serial networking attitude, we are connected with a few different bankruptcy trustee firms, and there's some interesting opportunities there as well. Even if a company is going out of business, they might have something that's of value that can be sold off, possibly at a profit, to help deal with debts and perhaps even get the owner something out. Even in the case of a dissolved corporation that has a lot of loss carryforwards, there's the opportunity for somebody to purchase those shares and utilize those loss carryforwards. So just because a company is in financial trouble doesn't mean there's no value there. It's definitely an interesting time to speak with someone like us or a bankruptcy and trustee or things like that. But it's very important to be very careful. There's a real, for lack of a better term, scumbag industry that's developed out there that will take your call, listen to you, and say, okay, come in for a meeting. They'll listen, it'll be $2,000, and then we'll get moving. And they essentially take that $2,000 and then refer you off to a third party who's going to charge you, who is going to consult you with you for free and do the work anyway. But because you found the kind of scumbag guy first, you'd be milked for $2,000 or whatever their fee can be. So it's very important to know who you're dealing with in those situations, because there are some predatory practices in debt resolution right now. All right. Has anyone heard of all of these? Tanya's nodding. Really?
I chuckled when I put the word common in. Maybe 3 or 4 of those are common, and the others usually run into them in larger sometimes public companies. But I have seen almost all of these, probably all of them, in different situations.
See, a lot of this stuff I haven't necessarily seen from a professional standpoint. My husband actually is a hobby day trader. So I hear about all of this stuff from him. So yes, so that's why, yeah, where you're right, the publicly traded companies, that's where I would have heard those terms from is again from him. And BNN is on constantly in the background here. So
That's great listening. Great listening. All right.
I tune it out these days.
Bob, was there anything specific you wanted to talk about on this slide, or I'm going to move on?
Yeah, well, I think the main pieces that we see are common stock and retained earnings. The one thing I will say about shareholders' equity in general, in connection with kind of doing bookkeeping, is be very careful about making transactions within shareholders' equity. They normally, we do a lot of journal entries to transfer transactions out of shareholders' equity and more into like shareholder debt balances, shareholder receivables, and payables. So you really have to think seriously if you're processing something in the equity section of the balance sheet.
All right. Try and keep making up time here. We've got 7 minutes before Tanya has to go. Okay, so some of the reasons to incorporate. I get this question all the time. Like, I want to incorporate. My first question is always why. You don't need to incorporate a business right at the beginning. If you are in a riskier industry and you want to limit your personal liability, or you have significant assets that you don't want exposed, it's a good idea to incorporate. This is the most important thing. However, it is very important to keep in mind that the corporate veil in Canada is nowhere near as strong as it is in the States. There are certain accounts you cannot mess around with. HST as source deductions are right on top of there. If you get messed up there, they can take your house. They can pierce that corporate veil, put a lien on your property, and sell your property out from under you if you're not working to resolve that. That's the personal liability. Limiting personal liability is important, but it's still important to be responsible. Tax flexibility and tax deferral reasons. There is a lower tax rate in corporations. You can hold excess funds inside the corporation and invest them. Of course, investment income is taxed at a higher rate than is active business income. And it can create a whole bunch of issues when it comes to succession planning. So if anybody has clients who are looking to either exit their company and sell their shares, or sell their assets, or share sales are usually in their better interest than asset sales. But if you're looking to like pass on to children, all of these different issues, that needs to be planned out in advance. It can't be like all of a sudden, okay, we're going to change, because there could be some other kind of, we'll call them more theoretical accounting issues that could create excessive tax liabilities that aren't really necessary if it's planned out properly. It also allows you to choose how to pay out the business profits to the ownership, whether that's through dividends, salary, bonus, different options like that, and when to do that, right? Like, are there excess funds to do that within the corporation? Have you taken a lot of money? I'm sure everybody's seen this. Somebody who uses the corporation as a piggy bank, and now they owe the corporation a lot of money. Well, CRA will come back eventually and say, that's regular income. That's your pay. So we're going to tax you as if that's salary, and we're not going to allow your corporation to take that deduction. It results in a lot of extra tax. It's very important to keep a close eye on shareholder loan accounts. And then, of course, there's more advanced structures like, well, we're working with quantum tax law in early June on the butterfly transaction. That's one potential. I'm not going to get in the details of it because I can feel people glazing over through the computer right now. But essentially, incorporation gives you a lot more freedom to do things. You can sell shares, bring on investors, limit liability, you can spread your income among family members or among staff, or give incentive to highly talented staff. You often see those kind of options in startups, for example. Now, selling the corporation can be easier than selling the assets in a proprietorship and partnership. Typically, what happens in this case is a Section 85 rollover. When somebody goes from being a sole proprietor to being an incorporated business, that transaction needs to be documented. And that new business, that incorporated business, is a completely separate entity from the individual. So it needs to be a tax-neutral transaction. That's called a Section 85 rollover. It doesn't always end up being a tax-neutral, but if you speak to your accountant before you do it, they can make sure they guide you in a direction that it is tax-neutral. I'm just going to keep moving. Probably the biggest con is cost. Name search registration, using a lawyer, the extra cost of filing, because it is significantly more work to do a corporate return. The prices are significantly higher. And then, of course, if you're getting into a situation where you need reviews or audits, you're likely getting into a five-figure bill, $10,000 or more for an audit, I would say. I haven't heard of any audits being much less than that. I think I've heard 7,500 was the lowest I've heard of. And of course, there's more administrative work. You have an income tax filing if you're a contractor, you have your T5018s. There's all kinds of different things that are required, and one that gets missed a lot is the informational return. So that's something to keep an eye out for your clients, and a very quick value add to say, keep an eye out for your informational return and let me know when you have it and I'll do it for you. There's a real opportunity because they're really easy to do. And then of course, the tax losses being trapped inside the corporation, not being able to offset personal taxes. That really, the only exception is if it's complete wrap up and ABIL applies, I believe, allowable business income loss. Bob, did you have anything to add to that?
No. There's some points coming up that I think we can cover when we hit the next slides.
Yeah, okay. All right, Bob, why don't you take over?
Yes. So when do you incorporate? At what stage in the life of a business do you think about incorporating? So mostly it's based on the size of the business. The way I think of it, if you need all the funds that your business is earning for your personal living costs, in other words, if you're taking out and spending everything that the business earns, then you probably don't need to incorporate yet. But once your business grows to the level that you're making more in the business than you actually need personally, you will think about incorporating as a vehicle to retain that excess cash. Inside a corporation, your earnings will be taxed at a lower rate than they will in your personal hands. So you may want to incorporate to hold that cash and use it for other purposes from within the corporation. Another reason, even if you're small, if you want to limit your personal liability, the construction business is a good example where you're probably more likely than average to be sued. So you might want to incorporate even at a small size if you own some kind of business where you're likely to have some legal liability. And then we kind of covered the tax benefits, and the other thing, the corporations have a better, reputation, I guess is a way to say it. So if you want to raise capital, you go out and you have a limited company or incorporated, and you may be more likely to raise capital. Gives you some credibility.
I'd just like to throw in something here, the importance of a shareholder agreement. quite often people will start a business on a handshake deal. That needs to be formalized. I have seen too many really good friends get torn apart because they didn't have a good shareholder agreement, and the business started earning money. And as we all know, money makes people funny. So just something to keep in mind. All right. Now, Tanya, I understand you're out of time pretty much. How should we proceed?
Because you guys can still go. The problem is the minute I hit record, I can probably give you about 10 minutes. Because because I can leave, but the minute I hit record on the other one, this is going to cut off automatically. And that's one of my boot camp sessions that we do record everything, but we don't start recording right away. There's the little bit like, how was your week? We don't record that. So we can do that. I can leave this up here, just me pop out and like I say, give you that extra time to be able to finish it. Then that way you can take questions and whatnot as well. And that should work. This is the first time I'm doing it, so I'm not going to promise, but from everything I've seen, I just can't multi-channel record, which again, as long as I leave this up here, or as long as I leave, it should be fine.
Okay. So
Actually, I think 5 minutes will be plenty for us to finish the presentation, and maybe questions can be done after we complete it.
Okay. Okay, well, and that's fine because, like I say, I'll give 10 minutes anyway, just in case, because I can't be in two channels at the same time. So I won't be able to see. I just know that as soon as I click record there, it'll cut you guys off. So why don't we just do that? I'll pop out, and I just won't, nothing before 10:40. I'll just make sure I wait till then. Does that work?
Thank you. Yeah.
Sure.
Perfect. Sorry, and I didn't realize until this morning. I literally been back to back since 8 a.m. So I've been jumping from one to, so I apologize. I didn't realize when I said everything, this was going to be one of those days, but.
Sure. We appreciate everyone's patience with this.
All right, perfect. So yes, enjoy. The recording will still go out tomorrow to everybody. And like I said, I will not start recording on the other until 10:40.
Okay.
Okay, thanks. Bye, guys.
Yeah. Bob, I'll let you take this one away. I've been talking for a while.
Okay, sure. You can wet your whistle. So just wanted to go through a quick example of the common types of shareholders equity entries that you'll be looking at. And this is going to go really quickly because a lot of them are very straightforward. You'll be very familiar with them. The important comment I wanted to make at this point is the importance of documenting shareholder equity transactions. Shareholders equity transactions are more critical than your general entries to have properly documented by, in most cases, very formal documents like your incorporation documents, your shareholder resolutions to support dividends, and if you're sending money to shareholders, is that going out as salary type of payment to them, or is it going out as a dividend? You need shareholder resolutions to support those. So anytime you're booking to shareholders equity, except for your normal closing the books at year end, rolling your net income into retained earnings, you'll want to think about documenting properly.
Yeah.
So, Jonathan?
I was just going to say, this is one of the weakest areas we've seen, is in the documentation in the corporate record book. That corporate record book contains board meeting minutes. It contains all your shareholder resolutions, all your incorporation documents, key contracts, key leases, things like that. It's really easy to compile, and it's really easy to do. If anybody Googles it, you can probably help your clients make minutes and make resolutions. But if you really, really, really want to be 100% on board with this, you should be using a lawyer, because there is a different language in the law that is not that the rest of us people who don't practice the law don't always understand completely. So if it is something that needs to be documented well, make sure it's documented very well. But more importantly, make sure something is documented, because we've seen so many times when there's nothing. Sorry for interrupting, Bob.
No, not at all. So we're going to go through these very quickly. Numbers 1 to 5 at least are transactions that are very simple. The entries are straightforward, so we won't spend a lot of time on them. The first thing, and this is going to follow the life of a corporation, starting from the common shares being issued, earning some income, paying out dividends. Then we're going to issue some preferred shares. Numbers 6 and 7 are a little less common, and we'll spend a little more time on those. So the first thing is issuing common shares on the next slide.
Oh, next slide, sorry.
Yeah. Now, the only trick here, well, not the only, but one of the things to pay attention to here is how much are you issuing the common shares for? They will often have a par value that'll be outlined in the incorporation documents, $1 a share, $100 a share, but the shareholders could contribute additional funds, and they intend those funds to be a permanent contribution to the corporation. In that case, what your entry is going to be to credit the common shares at the par value stated in the incorporation documents, and any excess above par value is going to go into an account called contributed surplus. So you may have to split the amount that the shareholders are paying in, or sometimes they're contributing assets, machinery and equipment. And this could relate to the Section 85 rollover that Jonathan spoke about earlier. So other than...
Sorry, Bob.
Yes?
It was a nice segue to Section 85, so I thought I'd just mention, you said contributed surplus was when it's a permanent contribution. There's no intention to take that out. When we do the Section 85, we usually put it to shareholder loan as a promissory note, so that the owner can get some of those assets back out in the form of cash after the fact without paying tax on it.
Yes. But if you have a number of shareholders, they may expect that to be part of the capital base, the permanent capital base. Like if you and I were shareholders and you're putting in $100,000, I would say I want that to go in as equity, not as, so you get into different situations.
Yeah, but there are different ways of handling it was the point of that. Anyway.
Yeah.
Next week.
Yeah. So the company earns income, point number 3. You're just going to roll out your P&L accounts into the retained earnings account, your normal year-end closeout. And when you pay a dividend, you're going to debit retained earnings and credit cash or credit a payable.
Now, what I like to do is I like to have that debit be in a separate account, just so it's tracked and then rolled into the retained earnings after the fact, just to I guess, document the transaction a bit more.
Yeah.
All right. Next slide.
Yes, please.
It's weird. It seems like I have to click twice every time to make a move.
So issuing preferred shares, as we mentioned earlier, preferred shares take a higher priority in terms of the dissolution or wind up of a corporation. So, but when they're bought or issued, the entry is pretty straightforward. Next transaction is if a company and an incorporated entity buys back shares. And I'll just say the repurchase, buying back by a company, doesn't necessarily cancel the shares. That has to be done as a separate shareholder transaction. So you can buy back, if you've issued shares for $1, you have 100 shares outstanding, so your capital account is $100. The corporation can buy those shares back, let's say for $50 a share. You will just extinguish the $50 in the common share account, and the excess debit will go to an account called treasury shares, which is an offset to in your equity section of the balance sheet. So you only eliminate from the common stock account the amount you first put in, and then any excess purchase is kept in a separate account called treasury shares. Now, those shares will be kept alive. They can be reissued if the company wants to, or they can be canceled. So the company has to decide if they want to keep them in treasury or if they want to cancel them, which is done by another shareholder resolution. And then the last example is if we get a change in accounting rules. For example, if a law is passed in a country, if there's a statutory requirement for a type of business to set up reserves. So they're going to reserve some of their equity for a particular purpose, to cover some debt that they've issued, to preserve some capital for buying fixed assets in the future. So the entry is to debit retained earnings normally and to credit an equity account called reserve for, and then you describe the purpose of the reserve you're setting up. So when you see that on a balance sheet, it just means that the company has set aside some of its equity base to be used for a specific purpose. It's not there for general purposes. Quite often it's done because of a legal requirement.
So what would be a good example of this, Bob, that a small business might see?
Well, I mentioned the buying fixed assets. Let me think. If you have some type of liability that's coming down, you might want to set up a, what's that?
For example, environmental cleanup for a mining exploration company?
Absolutely, yep. And again, this is something you're not likely to run into in smaller organizations, but something just to keep in the back of your mind, depending on the type of business you're dealing with.
All right. So we're done our presentation for now. Are there any questions? Please type your questions into the chat box, and I'll administer it. A couple of the things we really wanted to reinforce were the importance of accurate tracking of shareholder loan. That was very, very high on the list. We've seen a lot of business owners get into trouble there and end up incurring a tax liability that ends up taking them years to pay off. And then documenting the actual equity transactions and having a good corporate record book. And then the importance of a Section 85 rollover when someone is moving from a sole proprietorship to an incorporated business model. That is extremely important because if it's not documented, CRA can come back and essentially tell you what they think.
Really appreciate everyone's attention and attendance.
Thank you very much. All right. Thank you for attending, and we hope you found this of value.